In this video, I'd like to talk about what happens to companies when they make sales on account and they then realize they're not going to collect all of them. So what I want to show you here is what's happened so far in this particular example, which is the stock market example. We've had $1,500 of sales made on account as of the last accounting period. That's our beginning balance. Made 10,000 more sales on account this accounting period, which is in August. They've collected 1,450. So they got cash from customers, collected their receivables. And now what's happening is management's found out that $50 or a particular customer has gone bankrupt and that they're not going to collect from that customer. So what they're going to do is they're going to write off the specific customer. The way you write off a specific customer is you're going to credit accounts receivable for that amount, because every receivable has a company or a customer's name attached to it. So we are finding that specific customer's account and decreasing it. And that's a $50 write-off. So that write-off is going to reduce our receivables. Now the thought would be that we would expense that. But actually what is happening in this particular scenario, this is a new company, relatively new, and this is the first time they've had a customer not be collectible. So what's going to happen is instead of debiting the expense account, what we're going to do is debit an account called allowance for doubtful accounts. This account is a contra asset in that it has a normal credit balance, very similar to accumulated depreciation. So what you're going to see here now, after this has been posted, we have reduced our receivables for that bad customer, if you will, and we have debited this allowance account. Now what we're going to see going forward is that typically your allowance has some beginning balance in it. In this example, this is the first month that they've actually dealt with uncollectible accounts. So basically what's happening here is we have an abnormal balance for this type of account. We've written off more than we've allowed for. We've allowed for none to go bad, $0 to go bad. The company will fix that going forward. In fact, we're going to fix it now. At the end of the accounting period, management will review their receivables very closely, do what's called an aging, and estimate what they think they're not going to collect. In this example, if you look here, it says that management estimates 5% of its receivables will be uncollectible. What that's telling us is that we need this balance right here to equal 500. So I'm actually going to put that balance in here. And how I got that 500, I'll do a formula. It's your accounts receivable balance times 0.05. So in other words, management's saying that we need to get from a $50 balance on the debit side to a $500 credit side, because management says of the 100% of its receivables, 5% we think aren't going to be collectible. Well, you can't just put balances here. We have to make an adjusting entry. We have to get from a debit of 50 all the way to a credit of 500. Again, you're told this amount. So you basically now have to figure out what's it going to take to get from a debit balance of 50 to a credit balance of 500. Well, if you take a look at this right here, the way you're going to get from a, if you will, a debit side, which is positive for our assets, and get to a credit of 500, basically we're going to have to go from this point all the way to here. So we basically have to expense the 50 that we didn't last accounting period, and expense also an additional 500. So our adjusting entry is going to be for a total of 550, and that will get us to our proper ending balance, because again, if you take a debit balance and credit 550, it'll move us all the way to the credit side. So let's go ahead and do that entry. We are going to now, the credit's going to go to the allowance for doubtful accounts, and again that's going to be a credit, and it's going to reduce our assets because that's what management thinks they're not going to collect, and that amount is 550. Again, we had to get that 550 here. The way we did it is by crediting allowance for doubtful accounts for 550. What do we debit? Well, basically, if you think about it, some of these sales are bad sales, so we're overstating our shareholders' equity. So what we're going to do is record an adjusting entry to a new account called doubtful accounts expense. It reduces shareholders' equity. I'm going to have to fix that here, one sec. It makes shareholders' equity go down like expenses do. And again, that amount is your 550. So you'll see here now I have an expense for 550. It's going to reduce our net income, as it should, because we've made sales on account that we think will not be collectible. And that's how that works. So just to sum up, you're told what your ending balance has to be. As to the amount, it depends what your unadjusted balance is prior to making your adjusting entry. In this case, we had not allowed enough last period. In fact, we allowed none to go bad. So we are in the hole, so to speak. We need to get it all the way to the $500 credit side, so it takes a adjusting entry of 550. Debit doubtful accounts expense 550 and credit your allowance, and that gets us so that 95% of our receivables on our balance sheet will be showing as collectible. And that's it.